First, of course, I want to introduce our amazing panel. I'm going to let them each say a little bit about themselves. You'll get to know them better. But we're going to start with Gil, who is, let me just say one, who is HBS 2011, and truly one of the pioneers in the digital health space in New York. He was one of the very, very early one of the early founders, and so it's really great to have you here, Gil.
Well, thank you. Thank you guys. Thanks to two organizations started by Bunny, so thank you, Bunny, as well as Deerfield and SVB, who are both incredible partners and backers of my company, Rubicon MD. So my name's Gil Addo. I started a company, as I said, Rubicon MD, all 9 years ago now, with a focus on enhancing access to specialty expertise. What we do is we connect primary care clinicians and clinicians in the community to a network of specialists for what we call virtual specialty care. We are a venture-backed business. We raised around 4 rounds of financing and exited last year to a company called Oak Street Health. We are still Rubicon MD. We remain a wholly owned subsidiary, so my day job has not changed meaningfully, except I traded a board for a parent organization, and happy to talk about that among other things as well here. So thank you guys for the opportunity to chat.
Thank you. Shilpa?
Hi everyone. Is my mic on? No. I can just speak really loudly if that's helpful. Okay. I'm Shilpa Patel. I'm Kindbody's Chief Business and Legal Officer. I'm part of the founding team. We launched the company in the summer of 2018, and we are a fertility and family building company. We today operate 29 clinics across the country. Our core services are fertility services. Our clinics are tech-enabled. We offer supporting services to fertility and family building, including from prenatal through postpartum. And in addition to operating our own clinics, we contract directly with employers to administer the fertility benefit. And so I'm excited to tell you a little bit more today about what we're doing, our growth. We've done a lot in 3.5 years. That's why I have bags under my eyes. But it's really fun, and there's just a lot of movement in the fertility and family building space, and so excited to tell you more.
And Kindbody CEO Gina, who's a rock star, is also an HBS alum.
Yes. Our founder and CEO, Gina Bartesi, is an HBS alum, and she's also been in the fertility space for quite a bit of time.
Steve, guten Tag.
Is my mic working now? Okay. I'm Steve Gutentag. I'm co-founder and CEO of 30 Madison. We started in New York just over 5 years ago, with the goal to become the premier healthcare company for people living with chronic conditions. Fast forward to today, we've built 6 brands and offerings covering roughly 20 conditions, from men's hair loss, our Keeps offering, to much higher acuity dermatological or neurological offerings like Cove and Facet. And really exciting trajectory over the last few years, and most recently combined with a female-focused healthcare company called Nurex to form the largest virtual specialty care company.
And Nurex? The Nurex CEO was in my class at HBS, so it all comes full circle. It all comes full circle. All right, John Swope.
Thank you, Bunny. So first, thank you, Bunny, for continuing to partner with us here at SVB Securities. We're thrilled to be supportive of everything you're doing at NYC HBL. Thanks to Deerfield for hosting. John Swope, I lead digital health investment banking at SVB Securities. Recently rebranded, for some of you may know us as SVB Leerink, or Leerink before that. We are the investment banking arm of Silicon Valley Bank. I joined last summer, spent most of my investment banking career at Bank of America, where I most recently led digital health. Throughout that time, I've worked on countless M&A deals, and more recently, a number of IPOs and public market equity. That's not happening right now, but it will return. And in the meantime, back to M&A. And I'm, again, thrilled to be here. A couple partners in the room. Again, Stephanie Davis, our health tech research analyst, digital health. If you don't get her research, you should. And she was co-authored the women's health piece with Bunny in the annual newsletter. And who maybe should be on stage, my partner Jazz Singh, investment banking, was up till 3:30 last morning closing a health tech deal. But I'll speak instead of him.
Let me second that. I don't know you, although I'm sure you're awesome. I do know Stephanie, and she is a phenomenal analyst and a pleasure to work with. All right, so you are going to take us through the lay of the land, right?
I will briefly take us through the lay of the land so that we can get the operators and executives that live and breathe this. Okay, great. I can't see it on that one. But is this working?
Can you forward the slide?
Okay, great. So there's just a few quick slides. No doubt, after the run-up in public markets experience broadly in tech, but also in health tech from 2018 through 2020, the Icarus moment, as we call it here at SVB Securities, of the swift fall when they reached the peak has been felt across the board, with public market stocks in digital health down nearly 80% in the last few months, just since late last year. And the reality of this environment is that no doubt it will lead to M&A and consolidation in both public markets and private markets. The SPAC phenomenon is more or less gone. No, it is the case that plenty of SPACs still exist and are out there pounding the pavement trying to find partners, but are generally not available. Let's not lose sight of the fact that the megatrends have not disappeared. The triple aim of healthcare is alive and well, and reducing costs, improving outcomes, and engaging the consumer. Where investors, both public, private, and M&A consolidators want to spend time are the megatrends in healthcare: tech enablement, value-based care, and consumer engagement. There are a number of consolidators that still have checkbooks that will look, but they're not going to buy every digital health company out there. So there's going to have to be creativity. These three have all experienced the creativity in M&A across health tech. The areas of opportunity where the most focus is being given is women and family health and also behavioral health. No doubt, large markets that have historically been ignored in what we call healthcare and have so much room for improvement in the days, months, years, and decades to come. Next slide. So this is fresh and prepared for today's discussion. Much has been made of what, now that the contagion has spread beyond digital health to technology and the NASDAQ, we started thinking here at SVB Securities, can we draw some parallels? And it's striking the lines of today's digital health environment more or less overlap with what happened to .com back when I was in high school / college. And so the reality is maybe it's not over. There's perhaps another year of the malaise in public markets. Importantly, private financing is getting hit. We know, and we've heard this time and again, is that private markets lag. We're feeling that in Q2, and processes that I've run, valuations have been cut. Honestly, investors sometimes aren't even there. And the all-time highs of valuation of money flowing into the space will slow this year and next. They will come back. And M&A, it will peak later this year. It will slow down as deals get harder to do. Cash for those deals starts to run thin. But again, what we saw post-dot-com bust in both is that some of the best vintages for investments were 3 and 4. Those ones that are on the lower end of the tail. So while it will come down, those will be the best. There's still plenty of capital there. And M&A comes back too. And let's not lose sight of the fact that while the dot-com bust killed internet and software momentarily, it hasn't gone away. You look at the survivors and the companies that have come after, they're some of the largest companies in the world. And I believe that the digital health and health tech will follow a similar trajectory. When you think about what's important to people's health and the technology, it is really 2 decades behind. I think this is a precursor of that. Last slide, briefly, where have we seen activity? It's been across the board, a lot in virtual care. And this is something where when we think about the deals ahead, there will be many more to come across end markets and categories. Digital health is so broad, it really is just becoming healthcare. Thank you.
Thank you, and thank you for pulling the data for us in particular. So, well, with that, obviously markets are in turmoil, valuations are down. The irrational exuberance, as Clayton Christensen labeled it, of the past 2 years is somewhat waning. But we have 3 success stories here, and kind of want to get into what made you sell, what made you buy versus build, and those sorts of issues. So why don't we start with you, Shilpa, because as John said, women's health has been largely ignored for many years. So why don't you tell us a little bit about Kindbody, and you did a big acquisition this year.
Yeah, happy to. I'm not mic'd again. Okay, there we go. I'm happy to. So the women's health, I think, is very, there's obviously a lot of players in women's health, and we are focused on fertility and family building. And I think that's something that I found, and we've found in kind of our fundraisers. We kind of get women's health, all of the companies dealing with women get boxed into women's health. But I do, on the fertility and family building side, I will say that there's a lot of activity there right now, and interest. And our goal from day one when we launched the company was always to directly contract with employers. Our founder and CEO, the feedback that she got from her prior company, which is in the fertility benefit administrative space, was with those companies specifically, for certain high cost, low utilized services, they were contracting directly with certain centers of excellence and sending their employees to those centers of excellence. And so on the fertility side, why don't you explore that? And so she always kind of held that in the back of her head, and that's something that we've really executed on. So we started, we obviously couldn't sell a benefit to employers without having anything to sell them. So we started with launching our own clinic. So our flagship clinic today is on 15th and 5th, between 15th and 6th. We have another clinic in Bryant Park. We're opening a clinic in Brooklyn later this year, and we have 29 clinics across the country. And those 29 clinics, part of those 29 clinics was a recent acquisition of a network of clinics in the Midwest, primarily in the Midwest and in the Pacific Northwest, about 15 clinics. And our strategy generally has been to build versus buy. We have not been so focused on tuck-in acquisition. In the fertility space specifically, and physician practice management, it's more focused on tuck-ins. We realized let me take one step back. Before we launched the company, we considered whether to build versus buy, and we were actually leaning towards buying at first. And then it became very clear that we were not going to be able to execute on our vision with buying, and we needed to build. So we've had a primarily de novo strategy from day one, but this recent acquisition of its Bios Fertility and that network of clinics in the Midwest, the strategy behind it was threefold. Was we needed immediate growth to be able to service our employer customers, and they brought that growth. They were a well-run, efficiently run company that brought immediate revenue to the company, and that has been kind of, since day one, we've been focused on profitability, but the acquisition itself helped us accelerate our EBITDA, our path to EBITDA positivity by more than a few quarters, so that's great too. And then the third part of it is the synergy. They are a network of clinics. The clinic leadership is one that really kind of fits into our model, believes in what we're trying to do, which is really improve access to care, deliver a superior experience, and control for costs. And in the fertility space, generally the access to fertility has been reserved to those who can afford it, and this network of clinics is very much subscribed to what we're trying to do. So yeah, I think that's
very interesting. So, John, since you've been following this, are you seeing a lot more in the fertility space in terms of potential M&A activity?
It is a space that, while still nascent, clear leaders and winners are emerging for the digitally enabled solutions that the Kindbody brings to the table. And I think that with that environment, some of the smaller players will, Kindbody is becoming the acquirer of choice given the reputation that they're building. And so, yes, I think but it will be smaller ones that will be probably seeking out Kindbody.
Well, Steve, you just acquired a company in the women's health space. So, what was the rationale behind that?
Yeah, and I think similarly, it was Neurex was female focused, but it also was focused on HIV and PrEP and dermatology and migraine as well. We looked at this from two lenses, and I think Shilpa said this, which is we looked at it from a business perspective and we looked at it from a values alignment perspective. From a business perspective, we brought together two pretty large patient bases. So today we have roughly 750,000 people who rely on one of our services for care and treatment every month. And we had a pretty complementary patient base, so they were more female focused, we were more male focused. Today it's actually almost 50-50 split in the combined organization. So it brought us scale, but also diverse scale. The second is condition expansion. For us, we similarly work with payers and employers as well as going direct to consumer. And being able to offer chronic condition management, treatment, and ongoing support for 20 plus areas of focus is really compelling in one platform, one integration. And so this just really accelerated our expansion. And lastly, accelerated the payer and employer side, the enterprise side of our business. So we had been focused pretty heavily on building care. I think my mic might have gone out. Focused on building care contracts and care relationships. And in their start with contraception, they had focused on PBM relationships and medication. And so together, we have roughly 90% commercial coverage on the medication side. And this year, we'll have north of 60% coverage on the care side. So combined, end-to-end, patients coming through any of our offerings, if it's eligible for insurance, can use their insurance. And that was a really powerful combination on the business side. I think the other piece was values, though, and I think it's so important that they share the same values and the same beliefs in not just expanding access to care, but expanding access to expert care, really trying to up-level the type of care the average person has. Really putting that consumer-centric, that patient-first lens at the forefront. And actually just an interesting kind of side note, which was when we first met with their team at their office, we were sitting there, it was in San Francisco, and they have their values on the wall. And we were still in the process of getting to know each other. This was in the early phases. And we looked at it, and 3 out of their 5 values was almost word for word ours. And these weren't like generic values. Like these were very, very specific. And it was that was actually like one of the biggest catapults that brought us forward, was when we saw how much we cared about the same values and the same purpose. And that combination of business and values was what helped us really say that this was the right partner.
Well, actually, and before we get to you, Gil, you're on the other side, and you can participate in this too. You pointed out something, Steve, which I've been thinking about a lot. We talk, the M&A, the finance part, but really the human part is what's going to make it work or not work. And so I was curious from everyone here, how you keep employees engaged. And whether there's fear when all of this happens and that sort of thing.
Yeah, I mean, we're in the middle of integration right now, and that's top of mind. There's obvious fear on both sides of that we're mindful of, and I think by partnering with a company that shares your values and shares and really shares your mission, we are very focused on exciting everyone and getting everyone aligned, and I think that goes a long way. But integrations are hard. I think probably for you as well, and they're challenging in some ways. But then I always have my advice is it's just going to be painful for a little while, but the reward is at the onset.
I need to listen to Shilpa's advice on that one. I think integrations are definitely hard. The values piece, leaning into the values has been important for us, but also acting quickly and acknowledging that it's going to be uncertain and you can't predict the future. I think something that I had spoken with a friend who's been involved in a lot of mergers, acquisitions, and you name it. And he said something that I've really tried to keep top of mind, and I think is really important when you're doing this, which is find ways to honor the past, but build for the future together. And it's that combination. It's really hard to do, but really continuing to find ways where you can bring in elements of each other's cultures, learn from each other, but kind of throw out the plans and say we're building now together. And that balance is hard. It's really hard, but with that at the forefront has been one of the ways that we've been able to do it.
Well, Gil, your company is probably the oldest on this panel, I think. And so why don't you share a little bit about Rubicon and why you decided to go with Oak?
Yeah, I think for us, we had like probably the unique benefit of, so just for context, Oak Street Health runs primary care centers, so they run about 110 centers across the country. They were a client of ours for maybe 5 years, and so we had a strong relationship with them. So the acquisition was part of a continuation of a deeper and deeper relationship that we had had. And so just for context on how our deal essentially came to fruition, we went out to raise funding and additional financing tied to this vision for building beyond what we call the e-consult, which is essentially patients who go to see primary care clinicians getting opinions directly from specialists and moving towards virtual specialty care, which is having specialists virtually support patients, more complex patients, in the primary care. So you can bring specialists directly into primary care and create this broader set of services where you're collaborating on management of patients, they can support the patients. And so we had this vision that we could do this thing that, because we cover 130 specialties and subspecialties, we could do this thing that we really believed the world needed. And it required us to evolve beyond our core service to a broader set of services. And we went out to raise money to do that, and we were talking to Oak Street around that. They love that vision, and the conversations obviously evolved from there to them buying the business. But part of the strategic rationale was for us to do this type of innovation, we need to be as close as possible to primary care, but as close as possible to the patients. And this brought us much closer so that we could move much faster and we could execute against it. But we want to continue to sell this broader vision into primary care, which includes a lot of people who aren't Oak Street Health and some people who are competitive with Oak Street Health. And so we needed to remain at arm's length and we needed to remain separate. And I think that has helped us from, just bring it to the question, that has helped us from an integration perspective, because most of the integration is at the product level. It's not on the people level. We still are bringing cultures together. I think the comment around values is absolutely core. We knew that. It was kind of the base. Like, we wouldn't have started these discussions with somebody who wasn't values aligned, who didn't feel like they supported. Like, there are people on, like, we've created a lot more of a porous layer, even though we didn't need to. I was just at our office. We've got Oak Street people who work in New York, they're based in Chicago, who come into our office to sit, to work with our team. We've become, like, they've become friends, and vice versa. And that isn't as necessary because we've remained at arm's length, but it's because we've got such, like, deep values alignment. Our people knew a lot of their people. It was just like this group hug when we finally announced this. Everybody was just so excited on both sides. And so it's easy when you start with that to lose it over time. I think the challenge for us has been, as we've gotten deeper into the sausage making sure that we're continuing to reinforce the values alignment as it's getting harder to, build these products, and that we're finding ways to, kind of build culture together, right? So we've preserved the Rubicon MD culture, but we've taken elements from Oak Street and made it ours, and I think they've done a lot to like go the other way as well.
All right, so all of you have been successful, right, in yours, either the sale or the acquisition. So we're in a very different market right now, right? And I'm sure you get calls from other entrepreneurs figuring, right, asking what's going on, when should I sell, when should I think about selling, you too. So this is for all of you. How should an operator evaluate today's situation in thinking about a sale or, I mean, at some point, maybe an IPO?
My advice has been to sell at the top of the market.
You went to HBS, apparently.
And I think that strategy has worked perfectly. I'll just continue. I do think that there is a reality in this market that is clearly very different to 6 months ago, 9 months ago. But I don't think it precludes M&A. It's just that you have to be realistic about what that's going to mean. I think the people that I've talked to who are asking for some of this advice, you're seeing deals that are not cash deals, they're stock deals that with a lot more stock weighted in. You're seeing deals that have more milestones, like where people, will pay up for the value, but you've got to demonstrate that value along the way. So there's a way to get to a higher multiple, but that multiple is over time. And so I think this is without a lot of data points right now, but I think you'll see more of a shift towards that. And I think you'll also start to see more of an emphasis, I think Shilpa said this, like profitability matters a lot more than it did 6 months ago. Being able to be like sustainable growth matters a lot more. Being able to have a really sound business model. Things that just kind of sound like, if you're talking about business school, that you would just need to have in general, but those things weren't as valued 6 months ago when I think growth was, at a premium. So I think you'll start to see a shift towards that, and I think that businesses that still have that and can be realistic about the multiples you'll get can still go through M&A. For us, we had just closed a Series C earlier, or the year before. There was like a clear threshold that we wanted to get to, that we knew was there, that we felt like we were really valued at. In this market, could we get that? It may, it's a little bit of a different story. And so if that's not the case, then maybe you need to retool and wait a little bit to go to it. So that's a little bit how we thought about it.
Yeah, I mean,
Yep.
No,
you're
Shilpa.
actually probably
You should go first.
You're best to respond to this question, actually. But what I was going to say is, well, one, my advice would have been you should have sold last year. Is focus, and that's something that we are that is actually our main objective this year has been focus. My advice to others is really focus on your business model. There's a lot of I think last year so many companies were doing a lot of corp dev and kind of figuring out, let's bring in these different pieces and add it to our offering, and some of those things they're not revenue generating. They're not going to make you profitable. They're sort of nice to have, but they're not as meaningful. And my advice would just be focus, wait or adjust your expectations on your value.
I would echo what both Shilpa and Gil said. One maybe addition would be, think about anyone who started a company did it because they had a vision, right? Anyone who has a vision for what they want to be, and M&A, fundraising, profitability, you think about what is the way to deliver on your vision, and occasionally that's going to be by getting bought. Occasionally that's going to be by finding ways in this type of environment to hunker down and just live. And you can evaluate that at different points in time. So in this position at 30 Madison, we're obviously accelerating with M&A. Prior to 30 Madison, I had started a company that got bought. And we were at a time evaluating a fundraise versus joining a much larger company. And we felt that being part of a larger company was going to accelerate what we wanted to exist in the world and allow us to do it on a much larger scale and much more quickly. And so I think whether you're operating on your own, you're evaluating an M&A, but especially in this type of environment, think about it. You started this for a reason. What is the best way for you to fulfill and accelerate the reason you started it? And if M&A is the right path to do it, whether it's a good year or a bad year, you should think about it.
There are a lot of anxious management teams and boards out there right now. The reality is companies are bought, not sold. Yes, I'm a banker. And mostly I will agree with what Gil said, which is top tick market. I helped sell MD Live for 12 times revenue in February of 2021 for $2 billion when Teladoc was trading at 20 times and Amwell was trading at 30 times. They're both at, 4 and 1 respectively. The reality is that was a multi-year relationship with Cigna that culminated in a sale just before we were about to take MD Live public. And again, it was bought, not sold by the bankers. Now, if there is a banker out there that says that they can sell your company no matter what, you should hire her and not me. But I think that what the reality is, and I would build on what Gil said, what Steve said, which is that the range of options should always be on your mind, and of where the company can go organically, inorganically, with partnerships and others, with maintaining the vision and the mission, recognizing that that's going to have to evolve over time. And when you think about ultimately if a sale of the company is the exit, there's a range. There is people that just sit and build and stick to the vision, mission, and say, my company's beautiful, someone will come along. And then there's the alternative. We've heard about this. Companies that are built to be sold to Amazon, companies that are built to be sold to United Healthcare. And I don't think that either end of the spectrum is right. You should, for once in a while, pick your head up and think about the landscape, how it's moving and shifting, especially for those large consolidators that are only going to make a few acquisitions a year.
So we are going to start opening it up to the audience. So start thinking about questions. I'm going to ask one more before, but I know who I'm going to go to first. So given that you've all gone through this fairly recently, like what's one big lesson learned in the process that you would share, Gil?
The process along the way.
Yeah. That you wish you knew before.
I wish I knew. For us, the diligence was a really, really intense period, and I think that there was for our deal, there was a window of time in which that type of deal would have gotten done in the market, and we basically we optimized for. This is kind of hindsight. We optimized for making sure we were getting the absolute squeezing the pennies, thinking about how do we get this this number to be slightly higher than this number, when I think speed really matters because the environment's changed so quickly. And so thinking about, and I think that's even far more relevant right now. So just making sure that we're thinking about the speed through a lot of that diligence because of how fast the environment's changing versus thinking about every single term and exactly how you can maximize value in every way.
I'm sort of going to echo what you just said, but in a different way. We're still in the process. I don't know that I have the lessons learned from our acquisition of Bios, but we are in the process right now of acquiring companies that kind of support our core services, so in the genetic space and in surrogacy and adoption. And it is exactly what you just said. It is evaluating the risk of speed to acquire versus all of the, and I'm a lawyer, and all of the diligence that you have to do, and whether that's actually necessary. And I think the law firms are telling you, oh, it's all necessary because they want the
$1,200 an hour is what they want. Yeah.
But sometimes it's speed, it's acceleration to adding that partner, and in my opinion, you're just going to have to. You're generally cleaning up. If you're the acquirer, you're usually cleaning up a little bit of a mess, and so just kind of going in with that mentality.
Yeah, we're about 2 months post-close, so we are very much still in the learning phase, as opposed to the lessons learned phase. I will say, maybe to echo that, frankly, the balance of speed is important. I think it's interesting post-close, actually. You actually have to go a little slower, and you've been moving so quickly to get the deal closed, but then you have, especially if it's a larger group of people, you have to actually move a little bit slower to bring people along. And I think one lesson that I'm learning as we bring people along is you keep the quote-unquote tent really, really small until it's closed. And so you've been in it for months, and then you open up the tent and everyone's like on day one. And so you have to bring people along from the beginning, and that's something that I think is a lesson that is helpful, and that switch has to almost happen very quickly.
Interesting. So, Stephanie, well, first of all, with Q&A, we're very strict. Say your name, where you're from, and ask a question. And ask it fairly quickly.
Sure. Thank you. Stephanie Davis. I am the research analyst, also mentioned before, at SVP Securities, covering digital health. So, not mentioning any names to throw any shade, but large-scale mergers of equals often ends in tragedy in the public side of digital health. And I noticed all three of you looked at more of the defined parent mergers. Why? Would you ever consider anything else?
I think for us it would depend on the partner, and it would depend on the other company, and for what we're doing today. We administer a benefit, we operate clinics, we don't fit neatly with many partners, and maybe on the payer side there's that's a potential, but I'm not sure if I'm answering your question. But the answer is I think it depends very much on what the other company is, who the other company is.
I think, maybe quickly, I think they fail. I think in this environment, it's going to start to pick up. Buyers and sellers are getting a little more anxious, to use the word I used before. There's three that I normally use, but I'm going to take one from Steve and add a fourth, even though I like things to come in threes. 3 reasons they fail. Number 1 is valuation, relative value of merger of equals. Number 2 is governance, figuring out the board dynamics between the two, people issues. The third, what we in banker land call social issues, who's going to be the CEO. That's all that means. And the fourth, and this is the sticking point that I've seen as much, and I'm glad that you crystallized it, is values. Is there a match that sets up a belief? And you have to think each step of the way when you are a merger of equals, usually the deal falls down for one of those. And if it doesn't fall down beforehand, as the big, largest ever digital health merger I think you're referencing, has fallen down after the merger because of nearly all those things, if nothing else social. So that, those are hard to overcome, but maybe in this environment could start to be a little bit more.
The only thing I would add, we were exploring at the beginning of not last year, but the year before, we had some conversations with bankers around looking at could we be acquisitive and acquiring companies, and then we started talking to a few companies, and we thought we were the bigger company acquiring, and in their mind, when you listen to them, it was the opposite. And so I think just that's
social.
Those social issues, and I think that dynamic makes it really hard. And I think especially if it's equals where there's not a clear exit, somebody is paying somebody else, but you're putting stock together. I think those social issues become very real. Those are people I think they're great, but I left thinking this doesn't make any sense how you think you're valued at this or that. So I think those things just become magnified versus when you have these businesses where it is clear this person this is the strategic value that this thing is bringing to this thing, and we're going to figure out how to make the values really, really tight and the culture really tight. That becomes a lot clearer than when you kind of have social issues.
I think that sums it up.
Dorothy.
Hey, Dorothy Gemmel. I'm on the board of New York City Health Business Leaders with Bunny. Question for you all. In the last report that New York City Health Business Leaders highlighted, there in New York and then also across the country, there have been a lot of companies that have raised over $100 million in their last round. Give us your feedback as to, in the current market, what needs to change? So for all, what advice would you give those companies that have raised $100 million in this market? Do you think that a return to fundamentals around EBITDA, path to profitability, things like that are going to change? So, because there are a lot of them. I bet they'd love to hear your advice.
A lot in New York, too.
We were one of those. So I can
Yes, you are.
So I also think that you have to, not every company who has raised $100 million is obviously the same. There are ones that have done that on like very, very, very large multiples, and others that have done it on still large multiples, but depends. So I think the first thing is, one, understand, like any company, whether it's $100 million or $1 million, your runway, and what do you have to achieve. I think if you're a later stage company and you're a growth stage company, it's going to be really, really important that you know that this could last a very long time. And so either you got to become self-sufficient and self-sustaining on that, or you really need to think through, if you can't, what are the changes you're going to make yourself self-sustaining. There are going to be a lot more bridge rounds or top-up rounds or smaller rounds, and so understanding kind of how fast you want to go and how fast you want to grow at all costs versus a stable base along the way is going to be a really important one. And then I think it's going to be, to your point around fundamentals, depending on the environment, depending on the business you're in, making sure you really understand every lever that you can pull in your business. So that can be, if you're a consumer company, it's going to be obviously marketing spend and top line, but if you're selling something, every single line item on the cost you got to be looking at and saying, okay, we're here, where do we need to get to, and how do we get there faster? And that can often lead to a much better business at the long run if you execute it well. But you got to make sure you understand whether or not you're self-sustaining on that. Make the changes early, don't wait. If you are sitting on a large pile of cash, that's the best time to make the change versus when you're doing it out of desperation. And know that, I think the other one is if you were planning on a step up or a public offering as the only way to make it work, you gotta be planning something else.
Any other thoughts?
This environment, the last few years have been incredible, right? We've been tracking $100 million raises for the last decade, and there was like every month we'd update the list, and then in 2020 and 21, it was every week there was another $100 million raise, another unicorn. There's now 85 health tech, digital health unicorns out there. There's 25 or a little less public companies. And those 85 that are over $1 billion, they're not going public tomorrow, as discussed. Sorry, Stephanie. And the reality is that everything that Steve said is it needs to be batten down the hatches and perhaps be realistic about if valuation is one thing, there's still money out there. So there is still capital. It's drying up a little bit, but there's plenty sitting on the sidelines ready. And I do think there's going to be a FOMO of when the capital spigots start again. It's going to be another boom year in 23 for capital raising. Capital raising at what valuations is going to be the question. I think the boards and management teams are starting to come around, and they're also growing into those valuations. So we will see $100 million rounds coming again every week. They're just maybe the valuation those are done at maybe flat or down versus their last raise.
Okay.
Hi, Nicholas DeLejo, head of ESG investment banking at EF Hutton, and I also run a chronic disease intervention program based on yoga principles. Would love to know, in some of the acquisitions or the other side of it, were there certain KPIs, like in the value space, they all kind of aligned and there was that pure alignment. On KPIs, were there certain KPIs that weren't aligned to your strategy that you had to understand or integrate into your model? And can you talk to those, and if there are any social ones as well, beyond just who the CEO was or their power struggle. We'd love to hear some of those insights.
I can kind of speak too. I mean, the company that we acquired was a network of fertility clinics. They're in the service provider space. We also administer fertility benefits. So there's a learning on their side of kind of what we were very much aligned on revenue goals and clinical efficiency and learnings from them. Truthfully, it's part of the reason we acquired them was to make our company more efficient and bring in that clinical leadership. But on the enterprise side, it's a different sale and it's a different business model. And so really educating them. That said, we're still working through it, but I think it's really just an education and focus. I keep saying that we're very laser focused on what we're doing, and that is very much a part of that acquisition is maintaining that focus.
For us, we built, I don't know if there's any KPIs that are explicitly different. We wanted to understand their KPIs, and obviously we understood ours, and we needed to, what I was going to say is we needed to make sure that we had shared KPIs, and I think that was more important, that we use, just like some sort of like OKR framework, and these are the things that matter for us, and we're measured against it. We wanted to make sure that there was a team on their side that had the same things, and that they were also at the top of their list for priorities. And I've talked to some other portfolio companies of our investors who exited in the same kind of vintage, and things have really collapsed after the exit because the KPIs and what they were being measured on weren't shared with their parent, or who was just prioritizing other things and wasn't resourcing them to be able to succeed. And so I think it's less like we learned about KPIs, but we made sure that we were aligned in terms of what we were running at was the same as what they were running at. And we did that very early. And then we built culture around it. We had this thing called the Rubicon Run. We started to message it internally. They had people on their side who were held to it, who were supporting and running on it too. So that shared alignment became really, really important, and it has. And I also wouldn't say we're 8, 6, 7 months past. We're still learning lessons, but we have seen a lot of the early successes because of that.
I'd be curious on Steve's opinion on this one, because what I'm seeing, what we're seeing in health tech and digital health is SaaS and consumer KPIs creeping in. So LTV to CAC, gross dollar retention, net dollar retention, magic number, members, utilization, and average daily users, things like that 5 years ago, at least to me, LTV to CAC even was a foreign concept. And so as healthcare becomes more consumery, even if it's not true tech or true recurring, those metrics are adjusted versions are coming into play.
For us, it was, I think actually, we were fortunate. So Neurex and 30 Madison both operated originally with consumer focus. So LTV to CAC, how do you think about retention? How do you think about patient-based additional add-ons or upgrading their plans, downgrading plans? Those were metrics that both of us had shared. We were both 90+% subscription businesses. So we actually had a lot of mutual understanding, and we built a lot of the same frameworks. Now, how it shows up in the data is always a little bit different. We like to joke sometimes that we both built the Golden Gate Bridge, but one painted it blue and one painted it red. A lot of similarities, but the differences end up being at the final levels and the nuances. And so when we looked at the KPIs on both sides, it was LTV to CAC, it was the value of those customers. Are they staying with them? We looked at NPS. We looked at the outcomes that both sides were delivering. We really wanted to make sure that it was not just convenient, but it was actually delivering better outcomes in that categories. The last is we had very little overlap in areas, and in fact, in those areas, we kind of stayed away from deep diligence in the areas of overlap and more of the areas of complementary. And that was a really big part as well to understand across the portfolio of businesses.
So we have time for one more question. And after that, we have time for more networking because we'll be here until 8 o'clock. You, in the front.
Sure, I can shout.
Thank you. Hi, I'm Elena Mosqueta from Bold Health. My question is around advice for running a sales process. So when you're the smaller company selling and having discussions with multiple players, not sure any of you were involved in a competitive process, but how to optimize that, if to go around to the many 100 million raisers out there, or you mentioned it's the companies get bought, not sold. So how do you run a sales process that ends up successful and with good outcomes? Thank you.
I feel like that's a question to the banker, or
You guys all have perspective, certainly. And whether, when you're on the buy side, was it competitive? Did you know it was competitive? How do you navigate that? And then yours, did you think about options and run a process? So I'll take it quickly. Yes, companies are sold with help, right? And the process, I think there's two categories of buyers. There's the financial buyer, a private equity firm or some other growth equity that if they're in the mix for acquiring the company, it becomes a bit more, let's get all the numbers ready, all the diligence ready. If it's strategics and you're saying, my company, I've got a call from this strategic or two strategics, I'm interested, but should I broaden it beyond these two? The answer is almost definitely yes. You should do a market check, unless you say this fits with back to those 4 points of like value, social, governance, and valuation, values, social, and governance. If it's the right fit, then just go one, right? I'm doing a bilateral sale right now. If not, and a board normally would say that we need to optimize valuation and should do a market check. Even if no matter how hard or soft those inbounds are, or they don't exist, the answer with strategics is never call 50 strategics. It is, it's mind-numbing not only for the banker, but for the company to have to tell your story to strategics that, that the long tail just doesn't make sense. It should be a bespoke process that contemplates the most likely, that goes out to them first, gets them to dig in, and is always driving towards interim deadlines to keep it on track. I mean, the one reality, I've seen this too many times, is if it is bilateral, we'll keep dripping information, you're like, okay, this is another deal I'm working on. That was the case. The board decided to run a process. That one buyer that had been talking to them for months, they told them, we hired a banker, and the party's like, by the way, we think your valuation is $2 million. And the company is not only $2 million company. So, you need to think about how much information you're sharing before you get to the bottom line of, are they realistically a buyer at what could be acceptable to you?
So for us, so I would start by saying that we always kind of had a sense for who the universe was for, I call it liquidity, because it's not you're not exiting and leaving, but we knew that these were the kind of 3 or 4 pastures of buyers for Rubicon MD, and we always had relationships in there. Such that we could, place a call to those folks. So obviously you can't manufacture that near the end, but you probably have some of those relationships. What I found was you need somebody to step forward to kind of create that real interest and push. And then there's a second element, which is the people around the business, the investors, and where they are and whether or not they're ready for a process. But once you've gotten people committed that there is a process and there's somebody who's going to be really interested, then I think a lot of what was said is really important, because we did not end up running we got one group that came in, and then we sat on that and we looked at and we evaluated and we called a couple people who had reached out saying, hey, if you're going to sell the business, I want to be the first call. But what we did through a lot of our analysis was we understood what the strategic value was for Rubicon MD from the other side's perspective, and we knew that because of the strategic synergies that Oak Street Health was always going to pay more than most of the other groups. There was a small subset of other groups who we could have called, but those other groups, for the most part, like we would be starting the relationship from zero. And so this was a really strategic group, and so we said, let's see if this can work, and if not, we'll place the call to those other folks to keep them honest. But obviously we got there with this group, but the one thing I would say is like we had to keep them honest too, so that's not a process if there's only one person there. Okay,
Well, first of all, thank you all. It was really nice not to do Zoom. Right? Thanks, John, Steve, Shilpa, Gil, for giving us your time. We are going to be around until 8 o'clock, so please feel free to stay, drink, eat, and network.